I'm so grateful that my last video had such an impact. I will leave it to you in the upper right corner. And by the way, I'm so grateful that I have such a smart audience. Some comments were very interesting. Please comment below if you have something to say as well. Today we're going to talk about gross margin. I'm going to talk about first of the very basic things about gross margin and like how it's calculated, what is it, where we can find it, how it's related to the income statement, cost of goods sold and inventory, and what type of costs are considered there. Later we're going to do a gross margin analysis. We're going to tell you what variables impact on gross margin and how can we get an accurate interpretation for decision-making process. So if you think that's interesting, you should definitely watch this video. Don't forget to like and subscribe, hit the bell button and all to get all the notifications on the channel. So what is gross margin? Gross margin, also known as gross profit, measures operations profitability. It shows how much profit a company makes after paying off its cost of goods sold. Let's call them COGS. Normally we can find that on the income statement, also called a profit and loss statement. And we can find it in those three first lines. Now let's break it down and let's look at it just to see how we can calculate it. First we got the revenues minus cost of goods sold, and then we have the gross margin. So for every dollar generated while doing business, this means the revenue, there is a part consumed for paying back costs. This is the cost of goods sold, and then what is left is the gross margin. So revenues minus cost of goods sold, it's equal to gross margin. There are more expenses that are not taken into account because are not directly related into the cost of production. And now you're thinking about what is this? So what is cost of goods sold? It is what it costs you to produce the things you're selling based on your sales revenue, the money brought in by selling products or services. Yes, that's sales or revenue. Then costs are directly related to producing your products or services, and it includes labor costs. This is very important. There you have it, minus cost of goods sold. And obviously within a period of time. Companies normally use annual reports or monthly reports. These time frames are used to take decisions. And then we have the gross margin. And it's gross margin because we have not taken out all the other expenses while doing business, like our phone or electricity bill, administrative expenses. Of course, all of them must bring something valuable to your company or your business. So why inventory is key for the gross margin? So remember, we have a profit and loss statement or an income statement. Now we have all these three first line. Now let's break them down so we can see the big picture. So we have revenues minus cost of goods sold is gross margin. You have learned that already. And now how we can get to cost of goods sold? So cost of goods sold is calculated this way. You take your beginning inventory, then you take your purchases that you make during that period of time, minus your ending inventory after your sales occur. And then you have the cost of goods sold. So here is where you put the cost of goods sold, and then you get the gross margin. If services are sold, you need to calculate the billable hours. Now let's do a little bit of analysis of gross margin. Gross margin tells us how profitable the company's operations are. Higher margins are more desirable, of course. If gross margin is higher, more capital can be used to pay expenses while doing business, and increase business value if capital is used or invested correctly. Remember, we talked about utilities, phone bills, electricity, water, and things that will add value to your company. but not into the cost of production. Like administrative tasks, for example, hiring a good accountant or someone that will administrate and add value to that. Like service the debt, which is servicing additional capital to your company. Marketing expenses like your branding or your advertising strategy or something. And other type of expenses that it's very personal to every company. But there are many expenses that we will add here that are not related to the cost of production. So what variables impact on gross margin? First is the price. Obviously, if you increase the price, you are instantly increasing the gross margin. But we don't know if your target customers or anyone giving you money are willing to take that price. Then we have the supplier and labor wages. Obviously, if the suppliers increase their prices, which is the things that you buy to produce your product, of course, it will eat up your margin. And of course, if you increase labor salaries, will impact as well. It will, of course, reduce your margin, but maybe it's a competitive advantage. So you have to build a strategy to increase the gross margin or be efficient enough, effective enough, and fast enough to get the gross margin that you want. Let's talk about innovation inside operations. Innovation is one of the things that impact directly into the cost of goods sold. That's why everybody wants to innovate. And one of the things you can do instantly is innovate in your supply chain. So innovations inside the supply chain bring a lot of value to the company because it increases your gross margin. Of course, you have supply chain management as well. How are you dealing with the problems in your supply chain will for sure impact in your supply chain management and gross margin. Let me know in the comments if this was useful to you or if you want to comment any additional things or you have more doubts. If you want to know more things about financial analysis, don't forget to watch the other videos, like this channel, subscribe, hit the bell button, and all. Thank you very much. Please leave a comment or your likes. Thank you very much. See you next time.